In this video, we will explore corporate actions, specifically focusing on dividends, rights issues, and bonus issues. Let us start by understanding the concept of a dividend. When a company makes a profit and pays its taxes, it is left with what we call post-tax profits. Now, the company has a decision to make. It can take one of two paths. The first path is to keep that money and put it back into the company to help it grow, which we call plowing back. The second path is to give that money back to the shareholders, which is called a dividend. To decide which path to take, the management looks at a few things. They ask, do we have good opportunities to invest this money? What do the shareholders expect? And simply, is there enough cash available to actually distribute? Moving on to the timeline of how these payments happen. A financial year is a long period and dividends can happen at different times. If a dividend is declared in the middle of the financial year, it is called an interim dividend. However, if it is declared at the very end of the year, it is called a final dividend. Regardless of when it is declared, there is one very important rule you must remember. Once a company declares a dividend, it must pay that money to the shareholders within 30 days. Now, let us look at how the rules for declaring dividends have changed over time. Previously, companies used to declare dividends as a percentage of the face value of the share. This was a bit confusing. So, SEBI stepped in with a new mandate. Now, listed companies must declare dividends in specific rupee terms per share. The reason for this change is simple. It is to avoid confusion among investors so they can easily compare dividends between different companies that might have different face values. Let us clarify this with a practical scenario. Imagine we have two companies, Company A and Company B, and both declare a 50% dividend. This sounds equal, right? But wait, Company A has a face value of rupees 2. So 50% of 2 is just rupee 1 per share. Company B has a face value of rupees 10. 50% of 10 is rupees 5 per share. So even though the percentage is the same, the actual money you get is very different. Under the new rules, Company A simply says we are paying rupee 1 and Company B says we are paying rupees 5, making it much clearer for you. Next, we need to analyze how we track these payments and understand the tax implications. To see a company's track record, we look at something called the payout ratio. We calculate this by taking the dividend per share and dividing it by the earnings per share. Regarding taxes, you should know that dividends are fully taxable in your hands. If your total dividend income from a company exceeds rupees 5,000, the company will deduct tax at source known as TDS at a rate of 10% before sending the money to your account. Now we'll shift our focus to a different concept called a rights issue. Sometimes a company needs more money, which we call equity capital. They could go to new investors, but that creates a problem called dilution. Imagine a pie chart representing the company. If new shares are sold to strangers, your slice of that pie gets smaller. For example, if a company has 10 lakh shares and issues another 10 lakh shares to new people, the capital doubles to rupees 2 crores. But your proportionate ownership drops by half. To solve this, the law says the company must offer these new shares to you, the existing shareholders, first. When a company offers you a rights issue, you have three choices. Your first choice is to subscribe, which means you pay the money and buy the shares offered to you. Your second choice is to ignore it. If you do nothing, the offer will just expire. Your third choice is to renounce it. This means you transfer your right to someone else. You can sell this right to another person for money, or you can give it to a family member out of love and affection. Remember, buying the shares is a choice, not a compulsion. You might wonder, Why should I buy these shares? Usually, the price is the attraction. Shares in a rights issue are typically offered at a discount to the current market price. Let us calculate this. Suppose you are shareholder A and you hold 10 shares. The market price is rupees 100. The company offers a rights issue at rupees 70. That is a nice discount. If the ratio is 1:2, it means for every 2 shares you hold, you get 1 new one. Since you have 10 shares, you have the right to buy 5 additional shares at the discounted price of rupees 70. Let us walk through the process timeline. It starts with the record date, which is fixed to determine which shareholders are eligible. Then the company files a draft letter of offer with SEBI explaining why they need the funds. After that, they dispatch an abridged or shortened version of this letter to you at least 3 days before the issue opens. Finally, the subscription window opens. This window stays open for a minimum of 15 days and a maximum of 30 days for you to decide. What is the impact of all this on the company's books? If you look at the balance sheet, 2 things happen. On the asset side, the cash balance goes up because shareholders have paid money. On the equity and liability side, the number of outstanding shares increases. For you as a shareholder, if you subscribe fully to your rights, your percentage ownership in the company remains exactly the same, but the total number of shares you hold in your hand increases. Next, we will look at a bonus issue, which is sometimes called an equity dividend. Think of this as a gift. Bonus shares are given to existing shareholders for free. You don't pay any money. Conceptually, the company takes money from its reserves, which is technically shareholders' money, and moves it to paid up capital. It does not change the value of your holdings, but it is often done to make investors feel good psychologically. There is no actual economic change in the company. How many bonus shares do you get? This depends on your entitlement ratio. For example, a ratio of 1:3 means you get 1 bonus share for every 3 shares you already hold. There are strict rules on where this money comes from. Companies are allowed to use free reserves built from genuine profits. They are strictly not allowed to use reserves created just by revaluing their assets. Also, a company is banned from issuing bonus shares if they have defaulted on debt payments or fixed deposits. Let us look at the mechanism. We call this the capitalization of reserves. The reserves go down and the share capital goes up. Because the number of shares has increased but the company's overall value has not, the per share numbers must drop. The earnings per share will go down, the book value will go down, and the market price will also adjust downwards. However, your total ownership value stays neutral because you own more shares. Finally, let us prove this value neutrality with a mathematical example. Imagine you own 100 shares and the price is rupees 1000 per share. Your total value is rupees 1 lakh. Now, the company declares a 1:1 bonus issue. You get 1 free share for every 1 you hold. So, now you have 200 shares, but the market price will adjust to half, becoming rupees 500. If you multiply 200 shares by rupees 500, your total value is still rupees 1 lakh. So, the value remains the same, but the share price becomes more affordable for other investors to buy.